Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. There's a lot of noise in markets right now. Media headlines are saying one thing, economic data has been a mixed bag, while equities continue to push higher and display resilience, but remain volatile. Well, I have on the perfect guest, an industry expert, to share his insights into the noise and help us make sense of it all. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to Ryan Patterson. Ryan is the Chief Investment Officer at Linscomb Wealth. Ryan, thank you so much for coming on. It's an honor to have you on. Really excited about this conversation. I know I'm not going to screw up this name. A lot of times I get really nervous about some different names out there, screwing them up. This one I feel pretty comfortable and confident
I think I did
we're
it
going to be able
too.
to get through it. Yes. Can you please tell us a little bit more about yourself and Linscomb Wealth?
Yeah, no problem. I'd love to. And first, thank you for having me on. So I've been in the investment space for about 20 years on the institutional side before moving over a few years later to begin working with individuals. And the institutional side was very rewarding and interesting, but the working with individuals and families and getting to know the people that you're helping is just so much more rewarding than the institutional side. I've been with LW going on for 14 years now. Can't say enough things about the firm. Linscomb Wealth, we're an RIA headquartered out of Houston, Texas, as you mentioned. We also have offices in the Woodlands, Texas, Atlanta, Georgia, Birmingham, and Huntsville, Alabama. We just opened one in Nashville as well. Next year, we'll be celebrating our 55th anniversary, and we manage roughly $5 billion, and we have always been a holistic wealth advisor that focuses on the planning and the investment management side for our clients.
That's fantastic, Ryan. So hopefully you get to go travel and meet those at the new office, help open that new office in Nashville.
Yeah, I haven't
I'm
been there
hoping.
yet, but the individual who's out there, he's great. He was actually here in Houston for quite a while, and I am looking forward to going out to Nashville. It's a fun place, and we have several friends there as well.
Yeah, fantastic. Linscomb, you've been around for a while, and I like to know that you've been focusing on the holistic financial planning. I started 20 years ago, and back then, the holistic, financial planning, a few advisors did it, but it was all about brokerage, transactions, stuff like that. So it's good to know you guys have been doing it way before holistic financial planning really has been, you got to offer it now. If you want to be competitive in the space, it's something you have to offer. You've been doing it for a while. So it's good. Let's start talking about the current market environment. Like I said, there's a lot of noise out there that investors must contend with. Despite all the noise, equities, there's some volatility, some, little drops here and there, but they continue to head up, which means that it's really resilient. What are some trends you're seeing play out in the current market environment?
Yeah, right. So I agree. If coming into 2025, coming off of 2 years with plus 20% returns, I would say our expectations were a bit lower coming into this year. Having 3 years of plus 20% returns is very rare. I know it happened in the 90s. It happened at least one other time as well. I would say the market overall is definitely above our expectations. This year, even though we did see that volatility earlier in the year, especially on a lot of those big tech names, that came down quite a bit, and the S&P 500 almost came down 20%. Those AI stocks have definitely rallied back, continue to perform well. Also, one other thing to note, I think it gets left out of a lot of the news media and that, but under the radar, fixed income returns have been very strong as well. The ag up about 6.5%. That would have probably been our expectations for equities coming into this year.
Yeah. Yeah, that's a good point. And I'm glad you mentioned that the stellar returns for equities, not just this year, but going back for the past few years. Equities have shown resilience since COVID. It just, I wasn't that long ago, the yield curve was inverted. Everyone was talking about a recession, and now recession still hasn't happened. Equities continue to hit all-time highs. The Dow is close to 48. It just, it's like, when the shoe gonna drop? And it just hasn't happened, and they just keep moving higher. So, and a lot of it, like you said, is because of AI. Biggest theme in 2025, AI just keeps on driving markets higher and higher. It's resulted in some concentrated benchmarks, which I think there's some risks there. But small caps have performed well in 2025. And surprisingly, utilities have, surprised on the upside. And I believe it's the third leading sector this year. How does dispersion and sector concentration like that create opportunities and risks?
Thanks, Ryan. I can take a stab at a few of those. So, first, just touching on utilities, I would say, given what's driving market returns, you look at that, and I think at the end of the month, it was up 20%, as you said, third best sector in the S&P 500. It's due to AI. It's based on the infrastructure that they're building out. I think what a lot of people don't realize is the amount of power that actually takes to run AI. So a lot of power is needed there. And just as investors look forward, they've actually driven up prices of those utility stocks. Small caps, I think, is a little bit of a different story. Coming into the year, valuations were a little bit cheaper. And then one thing that I don't, maybe not everybody's aware of, but small caps are the debt for small cap companies is very different than larger companies. So their debt is more short term in nature. So as we saw rates start to come down, that helped out in the small cap area.
Yeah, that's
When,
a very good point. And
yeah, I mean,
in small cap,
I was
yeah,
just going to say one of the things you mentioned about the concentration and really, let's just say somebody owns the S&P 500. At the surface level, you would think you are diversified. We started talking about a few years ago as the top 10 holdings in the S&P 500 moved above 30%. Right now they're at 40. So that started becoming a concern for us. But actually, if you look even further, it's not that you have the top 10 positions make up 40% of the S&P 500, but the theme or the trade or the bet around those stocks, those stocks are highly correlated as well. It's not like you're diversified within those top 10.
yeah, yeah, that's a very good point, Ryan. A lot to unpack. With utilities, whenever you think utilities, you think of just a defensive play, dividend producers, income, kind of boring. Like you said, though, that's not the case right now, right? I mean, you could argue they're the foundation of this AI trade or the AI boom, right?
Yep.
And which can surprise some if you didn't realize that. Also, small caps. So small caps too, they're a little bit isolated from tariffs, correct? They're not global. Does that play a role too in their strong performance, you think?
Yeah, I definitely think that's an aspect as well. And I would say, just if we go back to maybe talking about AI, and you talked about the foundation possibly being the utility piece, there's a lot going on in AI right now. We talked about that trade or the theme there, and it's all based on the build out of the AI infrastructure. The companies that are doing that right now, they've traded at pretty high valuations for a long time. One of the reasons for that is they've had good earnings growth. But then at the same time, a lot of technology companies have been asset light companies. And them building this out and the cost behind that, they might not be able to get that premium if we say we're looking out a few years from now and the infrastructure cost of the upkeep is more expensive than maybe what's not anticipated in the market right now.
Yeah, that's a very good point. And going along with this story of, concentration and AI stocks, or it really is driven by that AI trade, the performance markets have become increasingly narrow. And it feels like if you're not overweight AI stocks, then you are at risk of underperforming. And when markets are up 20, 25%, last thing you want to do is be underperforming. I can imagine trying to generate alpha can be very difficult now if you're not investing in those 10, 15, 20 top AI names. How do you generate alpha and find opportunities in this type of market?
Our portfolios aren't necessarily designed just to beat the S&P 500. We're more diversified than that. But we do have a lot of US large cap exposure. One of the things I think you can look at are just the valuations on that top end of the market. They're very high right now. If you look at, let's say, the Russell 1000 growth, it's trading at a multiple of, let's say, 30. Valuations are a very hard timing tool, but if you begin looking at valuations going forward, they tend to be a pretty good predictor of future performance. Those names that have driven performance over the last several years, they're almost priced to perfection. And there's a lot of aspects of the market that are trading at pretty reasonable valuations. Everything's fairly expensive right now, but if you look outside of the US, we think there's value. Also, I think another thing, so many people are focused on the big AI stocks and the build out of it. But one of the big beneficiaries might actually be the companies that actually utilize the AI as we move forward, employing it, whether it's manufacturing, industrials, healthcare, financials, even some of the highly regulated industries could benefit a lot from AI and just the data and quick decisions, becoming more efficient.
Yeah, that's a very good point, Ryan. A lot of us, we think of the technology side, utilities, the foundation, the firms that are actually implement or offering AI. Not a lot of people think about, healthcare. I hear a lot about healthcare being one of the sectors, industries that really is employing AI and adopting it, and they're benefiting from it. So that's interesting. You talk about valuations. I read something recently where if you remove, let's say, the Mag 7 from the S&P 500, the the other 493, their PE ratios, their valuations are in line historically. So exactly like you said, well, yes, when you look at it in aggregate, it looks overvalued and prices seem lofty. But when you kind of peel away the onions and the layers of the onion, there are some opportunities there that maybe it's not as overvalued as some think. But also too, don't you think AI stocks in the Mag 7, their earnings like Amazon, every quarter their earnings are just shooting to the moon. Maybe they warrant these lofty prices.
You know, yes, they have done well. We've seen earnings come up. One of the things, if you look at over the last 2 years, though, as they begin building out these hyperscalers that are building out the infrastructure, you're actually seeing free cash flow stagnate. And so they have to invest a lot more into building that out. And it's what I was referencing earlier when it came to just maintaining that as we go forward. A lot of those chips, I think it's still we don't know exactly how long they last, but it seems like they might have to be replaced every 4 or 5 years. It's a pretty big cost. Also, they're all going to be competing with each other. Let's say a firm like ours, we want to utilize some of that service, or a financial company, energy company, and you're going to have somebody that does it better than others, but there might be not one of those companies owns that technology. So they're probably going to have to become pretty competitive on pricing as well. And that's where you talked about the other sectors, or not other sectors, but other companies within the S&P 500 outside of the top 10 or 7. One of the things that can happen is as those companies become more efficient, earnings grow, but then they're able to maintain a higher profit margin as we go forward as well, to where maybe you see some of those big tech names, the profit margins actually decrease, where you know you see some companies or sectors profit margins actually getting higher and being able to stay there because of the efficiencies.
Yeah, that's a very good point, Ryan. I love it. Let's switch here a little bit and talk more on the macro side. A lot of different things: labor market, inflation, the Fed maybe cutting another. I have one more cut this year, maybe 50 basis points. A lot of uncertainty there. Maybe some cracks brewing in the labor market. Inflation's come down, but remain sticky here. What are some of the key macro indicators you're currently watching?
Right now, there's not very many to watch, but hopefully we get those back soon. I would say
Yeah.
the main thing that we focus on is the US consumer. And our clients, we say this on videos a lot, but the US consumer makes up 75 or 70% of the US economy. And let's say we pay close attention to sentiment, but one of the things we've noticed is if US consumers, if they're happy, they're spending money. If they're depressed, they're spending money. But one of the things we do want to make sure is that they're keeping their job. So if they're able to keep their job, we tend to continue to see US consumers spend money that and retail sales continue to go up. So we pay very close attention to just labor market data, whether it's weekly claims, unemployment rate.
Yeah, very good point. I'm glad you brought up the health of the consumer because that we talked earlier about how equity markets are resilient. Well, the U.S. consumer remains resilient, and their willingness to spend, it's like nothing is stopping them. It's that train moving forward, and like you said, what would slow it down? Not having a job, right? So hopefully, labor market continues. We're getting them to be the most important part of the retail season, shopping season. So hopefully, that consumers remain optimistic, and we have a Santa Claus rally
Yeah.
this year. So, how are these indicators impacting your portfolio decision making with both in terms for equities and fixed income?
Yeah. Unless we think that there's a recession on the horizon, we tend not to get very defensive. All of our portfolios have a neutral weight, and then we can tactically shift over or underweight. But absent a recession, you typically don't have the big drawdowns. You do have periods like we did earlier this year where you can have quick drawdowns in aspects of the market, but there was still a lot of the market that was up even during that period of time. We really don't get defensive unless we see increase in claims, job losses, unemployment higher, and then a decrease in spending.
Yeah, that's a very good point. And I don't know. I feel as if everyone follows the Fed, labor markets, but it's at consumer spending. We are a service-oriented industry now, so retail is so important for the health of the
I
economy.
think one thing to mention too, you mentioned the Fed a few times. They're at a very different place when they were prior to 22 to where they have tools again. So they can go in and cut rates if they need to where there was a fear, I would say, when we had very low interest rates. And if you had any economic sensitivity there, obviously they can do quantitative easing and things like that. But it's good to see more normal interest rates, yield curves normalizing as well. So it's healthier than it was for sure.
Yeah, that is spot on, Ryan. I talk a lot about it on the show, just in the kind research about the normalization of macro policies. Following the COVID and even the Great Finance, that wasn't normal when interest rates were at zero. Like you said, what's the Fed gonna do if the economy doesn't turn around? Their tools are very limited now. We're normalizing. I think that's going to continue to play out and make for a healthier market and economy, into the future. So let's talk about the Liberation Day earlier this year. You mentioned it earlier. We had that really steep drawdown and high yield credit spreads spiked following that. Everyone was fearful, a lot of concerns out there. But since then, high yield credit spreads have come down. They really don't show any distress in those spreads. What is your view on high yield bonds? And are the movements in credit spreads indicating anything? Or the lack of movement, maybe?
Yeah, actually, I'm more than happy to talk about that. And just briefly talking about the way we construct portfolios. So we do view fixed income as the most conservative part of somebody's portfolio. We look for the diversification benefits. When we have big drawdowns in equity markets, we want that aspect of the portfolio to hold up. There have been times when we added, two high yield fixed income, but we're never going to take a big allocation of our fixed income allocation and move it to high yield. You mentioned just the health of corporate balance sheets and that. We do feel like the credit quality overall seems pretty good right now. And we watch spreads fairly closely. Spreads are very tight by historical standards. So we think it's probably expensive to actually add that risk. We'd probably rather own aspects of the equity market versus taking on risk on the high yield side. And core fixed income is very competitive right now. So I don't feel like there's a big need to reach for yield, but trying to get another 250, 300 basis points over treasuries right now. And we do have investment grade credit risk
Mhm.
on, but not high yield at the moment. From our standpoint, we don't think it makes sense.
Yeah, that's a very good point. And then there's total return opportunity there by holding fixed income moving forward. If we do happen to go into a recession or something happens, you've got total return possibility. Yields are still attractive. Real yields. Ryan, when's the last time we've had attractive real
Yeah.
yields? It's been a little while.
Yeah, it has. It definitely has.
So you talked about international stocks earlier. Fantastic run. Earlier this year, everyone was talking about U.S. supremacy's coming to an end. International stocks have finally outperformed. They're having their day. Well, it's continued. The outperformance for international stocks, not even developed, but also emerging markets. Emerging markets had a stellar 2025 so far. Do you see this strong performance continuing? You mentioned earlier about valuations being more attractive. Do you see it continuing?
Yeah, we still think there's opportunity in the international space. Just the way international markets are structured are very different than US. So they don't have the big growth aspect. They don't have a lot of big allocation of technology like we do here in the US. So just adding to international from that standpoint, we feel like adds some diversification benefits. And some of that utilization that we talked about from the AI standpoint, we think can be deployed overseas as well. But going back to valuations, international stocks, even though they've outperformed US markets by a significant margin this year, they're still trading at a fairly significant discount. So international stocks are trading at about a 34% discount. I think at the biggest gap that we saw was a little over 40. Um, it was a good hedge against the US dollar as well, weakness there this year. And we're not really big on technical analysis, but there is pretty strong technical cases for international whenever it outperforms by a 12-month period of time. It tends to last for a little bit longer. So trend could be changing as well.
Interesting. I haven't. I'm glad you brought up technical, and I focus on fundamentals, charting that goes over my head, lines and stuff like that. But I'm glad you brought that. It's a very good point and one worth considering when you think, does this trade still have legs? And for me, it comes back to valuation. You got and diversification too, just helps with the portfolio. When before for the past few years, it's like, why in the world am I investing in the EFI International? It's outperforming. It's a drag. Now we're getting rewarded for that patience.
For quite a bit of time, we had a strong dollar as well. That was a headwind to
Mm.
it. I know it's been a frustrating asset class if you look back over the last 10 years or even since the great financial crisis. But we do believe that it has a place in a portfolio from a diversification benefit. And even during the volatility earlier this year, it held up really well. A lot of
Yeah.
benefit was added then.
Yeah, very good point. Outside of diversification and the valuations being cheaper, is there anything else there that makes international equities more attractive for you guys compared to US equities?
The international markets are so much larger than just comparing international overall to US, but there's things happening all over the world. And whether it's in the developed markets, there's some, we think, in developed Europe that AI utilizers there could be a big benefit there. Japan, they're very technology focused. They've had corporate governance reform as well. Shareholder returns have gone up there. And then you just look at just building out the AI infrastructure here. There's a lot of emerging economies that can help with that.
Yeah. Yeah, very good point. And then, in China, you know, all the, AI coming out of there and we've seen it in returns, good big turnaround there coming out of China. Lastly, I can't believe I'm going to say this, Ryan. We've only got a month and a half left of this year. What are you going to be watching the remainder of this year before the calendar turns? I should be asking what to expect in 2026. It's coming up so quickly, but what are you watching the remainder of this year?
It will be interesting to see if the government shutdown did have any impact on economic growth or earnings. I'd say the main thing that we're going to focus on is that U.S. consumer data that should be coming out here fairly soon. For the labor market, we're at full employment. We don't see a recession on the immediate horizon, but employment can't get very much stronger because we're doing pretty well right now. So just watching for some of those signals of weakness there.
Yeah. Yeah, very good point. And you know, especially now the last month and a half, month, really I'll be watching a lot of the numbers from consumer spending, early indication of how well the shopping season's going. It might give us some momentum going into 2026. So, a lot to watch for. Very good. Ryan, awesome. Very fun conversation. I really enjoyed it. I always love talking about the markets and the macro side. Great job. Such an honor to have you on. A lot of fun. And I didn't butcher your name, so I did something right. Did something right. Where can our audience get more information about Linscomb Wealth?
At our website, linscombwealth.com, and then also LinkedIn. They can follow Linscomb Wealth on LinkedIn as well.
Fantastic. Thank you so much, Ryan. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe and like those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.